Welcome to Fine Print Exposed, the series where we read the documents nobody reads and tell you what's actually in them. Every financial product has a marketing version and a math version. The marketing version is the number they put in the ad. The math version is what you're actually paying, earning, or losing. Our job is the math version. Episode 1 is the Self-Credit Builder Loan. Because the marketing version of this product is almost perfectly designed to obscure what it actually is. Self-advertises, $25 per month builds credit. Here's what $25 per month actually costs you, and whether that cost is worth paying. The fine print nobody reads on credit builder products works like this. The number in the headline is a monthly payment, not a savings amount. Self is not a loan where you receive money upfront. Self is not a savings account where you earn interest. Self is a specific financial instrument, a credit builder loan, and the way it works is structurally different from both of those things. You make monthly payments into a certificate of deposit. At the end of your term, you receive the money back, minus the administrative fee and interest Self charges for operating the account. The money is yours at the end. It is not yours in the beginning. And the fees and interest are the real cost of the credit history you're building. If you've ever looked at a credit builder product and wondered why the math didn't feel right, this video shows you exactly why. We pulled Self's current product disclosures, their fee schedule, their APR disclosures, and their credit bureau reporting policy, and ran the math on the most commonly advertised 24-month plan. And we brought Marcus in for this one, because Marcus is 2 months into his own credit rebuild, and he arrived today believing that a credit builder loan is basically a personal loan with a payment plan. Marcus, it's basically a loan with a payment plan. Claire, it is not a loan with a payment plan. Marcus, I know what a loan is, Claire. Claire, let's find out. Here is the exact mechanism, no marketing version. When you open a Self-Credit Builder account, you are not receiving a loan. You are agreeing to make monthly payments into a secure account, a certificate of deposit that Self holds on your behalf. Self reports your payment history to all 3 major credit bureaus, Experian, TransUnion, and Equifax, each month that you make an on-time payment. At the end of your term, 12 months or 24 months depending on your plan, Self releases the funds in the CD to you. What you receive is the total amount you paid, minus Self's administrative fee, and the interest charged on the account. Marcus, wait, so I'm paying interest on money that's already mine. Claire, you're paying interest on the loan structure that exists to report your payments. The CD is collateral for the credit builder account. Marcus, that feels like a lot of words for you pay fees. Claire, it is fees. The question is whether those fees buy you something worth buying. The 24-month plan, at approximately $25 per month, means approximately $600 total paid over the term. At the end of 24 months, after Self's administrative fee and interest charges, you receive approximately $520 back. The net cost, what you paid minus what you receive, is approximately $80. That is what you are paying for 24 months of on-time payment history, added to your credit file, across all 3 bureaus. Marcus, so it's $80 for the credit history. That's what we're really buying. Claire, that is correct. Marcus, I knew it was something like that. Claire, you said it was a payment plan loan. Marcus, I said it was loan adjacent. In the neighborhood, that $80 purchases something specific. Here's who that purchase makes sense for. Scenario 1, thin file, no credit history at all. If you have never had a credit account, no card, no auto loan, no student loan, your FICO score may not exist yet, or maybe in the 300 to 500 range from insufficient history. 24 months of on-time installment payment history, reported to all 3 bureaus, builds a file where none existed. For someone in this situation, $80 over 24 months is a rational cost for establishing a trackable payment history. Scenario 2, sub 580 score, unable to qualify for a secured card. Some secured cards require a credit check that people with very thin files or prior negative marks cannot pass. If you cannot access a secured card due to credit check requirements, a credit builder loan, which typically does not require a credit check, becomes one of your few options for adding positive payment history. Scenario 3, no deposit funds for a secured card. Even no annual fee secured cards typically require a deposit, $200 minimum for most cards. If you cannot access $200 for deposit right now, but can manage $25 per month, Self structure allows credit building without an upfront deposit. Marcus, if I did Self and got a secured card, would that help more? Claire, yes. Credit mix accounts for 10% of your FICO score. Having both an installment account, which is what a credit builder loan is, and a revolving account, which is what a credit card is, on the same file is more valuable to the scoring model than having just one type. Marcus, I knew that was going to be the answer. Claire, you asked the question 30 seconds ago. Marcus, I was verifying. If you can qualify for a Capital One Platinum secured card, no annual fee, approachable credit check, standard secured card structure, you should do that instead of self. Here's why. The Capital One Platinum Secured builds the same on-time revolving payment history self builds via installment. You get your deposit back when you close the account. The annual fee is zero. The net cost compared to self's approximately $80 over 24 months is meaningfully lower, and you are building revolving history, which is the type of account that most people will use for the rest of their financial lives. Self makes sense specifically when you cannot access a secured card. Not as a complement to a secured card you already have, not as an alternative to a secured card you can get. Alternatives to consider. Chime Credit Builder is a product with a different structure, no hard credit check, secured by your Chime spending account balance, no interest or fees on the Credit Builder account itself. For someone who banks with Chime already, this is worth examining before self. Before the verdict, the full product comparison spreadsheet self versus secured cards, side-by-side math with current fee ranges, is at cardsmadesimple.com/rebuild. If you're in the rebuild process, that spreadsheet tells you what to do in what order based on your current score. Free. Link in description. Here is the verdict on Self Credit Builder. Self makes sense for thin-file rebuilders who cannot access a secured card, either because they cannot pass a credit check or cannot fund a deposit right now. The net cost of approximately $80 over 24 months, for 24 months of bureau-reported installment payment history, is a rational trade for someone in that situation. If you can access a secured card, specifically one with no annual fee, like the Capital One Platinum Secured, that is the better first move. Same credit building outcome, lower net cost, revolving history rather than installment. If you can do both, a secured card and self simultaneously, you are building both revolving and installment history at the same time, which is more valuable to your FICO score than either alone. Self is currently available at approximately $25 per month for the 24-month plan. The direct application link is in the description. That is not an affiliate link. Self is not currently on Amazon, and we are flagging the link for manual insertion. 24 months from now, you can have 24 months of clean payment history on your file, or you can still be in the position you're in today. One account, one decision. Marcus, I'm going to do self and the Capital One Secured. Claire, that is the correct answer. Marcus, I was going to say that from the beginning. Claire, that covers credit builder loans. Next, fine print exposed. The secured card fine print nobody reads, what the deposit actually does when your limit increases, and the one fee buried in the disclosures that most people don't see until month 6. Fine print exposed episode 2, subscribe. It drops next Wednesday. If this helped you understand what self actually is before you open an account, the like button is right there. If it just confirmed what you already suspected, the like button is still appreciated. Every Fine Print Wednesday on Cards Made Simple, we break down one financial product's hidden costs. Subscribe, and you get next Wednesday's episode the day it drops. If you're rebuilding credit, the 500 to 700 roadmap is at cardsmadesimple.com/rebuild. If you're optimizing rewards, the card match guide is at cardsmadesimple.com/match. Asterisk, this content is for informational purposes only and is not financial advice. Credit card terms, rates, and offers change frequently. Verify all